Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Arista Networks, the company that built the invisible infrastructure connecting AI data centers at hyperscale.
Arista was founded in 2004 by Jayshree Ullal, Andy Bechtolsheim, and David Cheriton. All three were veterans of Sun Microsystems and Cisco, deeply familiar with what enterprise networking lacked.
The company's central innovation was EOS, the Extensible Operating System, a single software image that runs identically on every Arista hardware platform, from the smallest campus switch to the largest core router.
That architecture matters enormously. When a cloud operator deploys thousands of switches running EOS, the operational cost of migration to any alternative becomes prohibitive. Switching costs compound at scale.
Arista went public on the NYSE in June 2014 at $43 per share. Jayshree Ullal became one of the few female CEOs to lead a technology company through an IPO and remains at the helm today.
Cisco challenged Arista with significant patent litigation following the IPO. The dispute was ultimately settled, and Arista emerged with its technology validated and its competitive position intact.
The revenue model is straightforward. Hardware products, primarily Ethernet switches, represent about 75% of revenue, with services and support making up the remaining 25%.
What sets Arista apart from most hardware businesses is its margin profile. Gross margin runs around 64%. Software-like economics on networking hardware driven by OS's value over the commodity switch price.
Arista's three largest customers, Microsoft, Meta, and Google, are sometimes called the Cloud Titans. Together they account for over 30% of Arista's annual revenue, reflecting the hyperscaler concentration risk.
When hyperscalers spend on AI infrastructure, they need networks that can move data between thousands of GPUs at extremely low latency. That's the problem Arista's high-density spine-leaf switching architectures are designed to solve.
Arista co-founded the Ultra Ethernet Consortium, an industry group developing open standards for AI GPU cluster networking. This positions EOS as the open standards alternative to Mellanox InfiniBand, which NVIDIA acquired in 2020.
Enterprise campus networking is a growing second leg. Arista's Cognitive Campus platform extends EOS into corporate networks, a market historically dominated by Cisco that Arista is disrupting with better software automation.
Operating margin runs around 43%, exceptional for a hardware-led company. Arista generates free cash flow of roughly $2.8 billion annually and carries no meaningful debt.
Jayshree Ullal spent 23 years at Cisco before joining Arista, where she built the switching division. Her deep industry relationships helped Arista land its first hyperscaler customers before the company had significant brand recognition.
The main risk for Arista is concentration. A significant spending slowdown at Microsoft, Meta, or Google would directly impact revenue. The company is actively diversifying into enterprise and federal to reduce that dependence.
The competitive radar shows Arista's EOS software moat and hyperscaler depth scoring significantly higher than Cisco and Juniper, though Cisco's broader portfolio and installed base remain advantages in the mid-market.
That's the Arista Networks chapter. One operating system, every switch, the world's largest clouds. EOS built a moat that compounds the longer hyperscalers depend on it.
Networking infrastructure is unsexy until you realize every AI computation depends on it. Arista is in the ground floor of that build-out. Let's get into the numbers.
Arista Networks just reported Q1 2026 results that confirm one thing. AI data center spending is showing up in the networking layer. Revenue came in at $2.709 billion, up 35.1% year over year. Non-GAAP EPS of 87 cents beat the street by 7%. The hyperscalers are building, and Arista is connecting the GPU clusters. This is Charged Alpha. I'm Hudson.
And I'm Lana. Arista Networks designs cloud networking hardware and software, primarily Ethernet switches for large-scale data centers and enterprise campuses. Its extensible operating system, EOS, runs as a single software image across every Arista platform. That architecture creates switching costs that compound as hyperscalers deploy thousands of switches. Revenue splits roughly 75% hardware products and 25% services and support.
Arista's three largest customers, Microsoft, Meta, and Google, collectively account for over 30% of annual revenue. When those companies ramp GPU cluster builds for AI workloads, Arista sees it directly in its switching orders. The company went public on the NYSE in 2014, and Jayshree Ullal has been CEO since founding. Market cap is approximately $184 billion.
Q1 2026 revenue, $2.709 billion. The street was expecting $2.617 billion. That is a 3.5% top-line beat. Year over year, the growth rate is 35.1%. For a company already running above $7 billion in annual revenue, sustaining that pace of acceleration reflects the scale of AI infrastructure investment flowing through hyperscaler budgets.
Non-GAAP EPS printed at 87 cents versus the consensus estimate of 81 cents, a 7.7% beat. GAAP EPS was lower, reflecting stock-based compensation and other non-cash charges. Non-GAAP gross margin came in at approximately 63%, near the upper end of Arista's historical range and substantially above typical hardware company margins. Operating margin ran around 41%.
The quarterly revenue trajectory tells a compelling story. Q1 2025 was $2.005 billion, Q2 was $2.205 billion, Q3 was $2.308 billion, Q4 was $2.488 billion, Q1 2026 lands at $2.709 billion. 5 consecutive quarters of sequential growth, driven almost entirely by hyperscaler AI infrastructure spending. The ramp has not plateaued.
The balance sheet is a standout even in a sector of strong balance sheets. Arista carries approximately $1.96 billion in cash with zero long-term debt. Net cash position is just under $2 billion. That financial strength lets management invest in R&D without capital constraints while returning cash to shareholders through buybacks. There is no financial leverage risk in this story.
Free cash flow on a trailing basis remains strong. Arista converts revenue to cash at a rate that reflects its software-driven margin profile. Non-GAAP operating margin in the low 40s is extraordinary for a hardware primary business. EOS is the economic engine behind the margin story. Once EOS is running on a customer's infrastructure, the incremental cost of software updates is minimal while the value delivered grows with the network.
Management raised its full-year guidance outlook for 2026, reflecting continued confidence in hyperscaler spending visibility. Arista does not provide quarter-by-quarter explicit guidance, but the raised full-year framework implies Q2 will show continued growth above the 30% level on a year-over-year basis. The pipeline of AI cluster networking projects at Microsoft, Meta, and Google remains the primary demand driver.
The analyst community maintains a broadly constructive stance on Arista. Most major sell-side firms carry a buy or outperform rating. The consensus price target runs near $160 to $170, implying roughly 10 to 15% upside from the current share price near $146. After a 7.7% EPS beat, expect target upgrades from the sell side.
The bull case from sell-side analysts centers on AI cluster networking as a secular infrastructure cycle. Unlike prior data center build-out waves that were driven by storage and general compute, AI GPU clusters require significantly higher network bandwidth, up to 50 times more than traditional data center workloads. Analysts modeling Arista's share of that spend see a multi-year runway that current revenue does not fully reflect.
The skeptical view focuses on CapEx timing risk. Hyperscaler spending on data center infrastructure is not linear. Large build programs create quarters of intense order activity, followed by pauses as infrastructure is absorbed. Some analysts who model Arista on a project-by-project basis flag that Q2 or Q3 could see lower order inflow, even if the full-year story remains intact. Revenue lumpiness is real, and historically has caused multiple compression.
There is also the InfiniBand question. NVIDIA's InfiniBand interconnects, acquired through the Mellanox deal, remain the dominant choice for dense AI training clusters at the most intensive GPU deployments. Arista's Ethernet-based solution, promoted through the Ultra Ethernet Consortium, competes primarily at the scale-out layer and for inference workloads. Analysts tracking the training cluster spec split watch this carefully as it determines Arista's TAM ceiling.
Valuation is the most consistent source of analyst debate. Arista trades at roughly 20 times trailing price to sales, a premium that implies the market has already priced in continued above-market growth for multiple years. Analysts who carry a neutral or hold rating cite the multiple as the primary concern, not the business fundamentals. The stock is priced for an extended period of 30+% growth, which is a high bar to maintain.
The bull case for Arista starts with secular AI infrastructure demand. Hyperscalers have publicly committed hundreds of billions in data center capex through 2027, and every GPU cluster requires Ethernet fabric to connect nodes, spine switches to aggregate traffic, and EOS to manage the whole stack. Arista is not a bet on which AI model wins. It is a bet on the build-out happening at all.
The EOS moat compounds the bull case. Once a hyperscaler deploys thousands of EOS-based switches, migrating to an alternative operating system means retraining every network engineer, rebuilding every automation script, and reverting every EOS-specific configuration. That switching cost grows with each additional switch deployed. It is a self-reinforcing retention mechanism that Arista's competitors cannot easily replicate.
The enterprise campus opportunity adds optionality. Arista's cognitive campus platform extends EOS into corporate networking, a market where Cisco has historically held dominant share. As enterprise IT teams seek to standardize on a single operating system across campus and data center, Arista's platform play gains appeal. This diversification gradually reduces hyperscaler concentration risk.
The bear case begins with hyperscaler concentration. Microsoft, Meta, and Google account for over 30% of Arista's revenue. If anyone pauses AI infrastructure spending due to capital discipline or a shift toward custom silicon, Arista's revenue trajectory changes in the same quarter. That concentration is the most direct near-term risk.
CapEx timing risk is distinct from CapEx direction risk. Even if hyperscalers maintain full-year commitments, quarterly order pacing is unpredictable. A large GPU cluster project may generate significant switch orders in Q1, then nothing in Q2 as the facility is built out. Arista's numbers can look choppy even in a structurally growing market. The street has repriced ANET sharply on CapEx timing surprises.
NVIDIA's interconnect ecosystem is the third structural risk. InfiniBand, which NVIDIA owns through Mellanox, provides lower latency for dense AI training workloads than Ethernet at comparable bandwidth. While Ethernet is catching up through the Ultra Ethernet consortium, NVIDIA has a clear incentive to favor its own interconnect. That creates a ceiling on Arista's AI GPU cluster TAM.
Valuation risk rounds out the bear case. At 20 times trailing sales, Arista is priced for perfection. Any quarter with revenue below 30% year-over-year growth, a margin miss, or a guidance reduction would likely trigger meaningful multiple compression. High multiple stocks in cyclical infrastructure markets historically give back significant gains when growth decelerates.
The primary peer comparison is Cisco Systems. Cisco's data center switching business has been losing share to Arista for a decade. Cisco's gross margin in networking runs near 60%, but revenue growth is in the mid-single-digit range. Cisco's multi-product portfolio provides diversification that Arista lacks, but its growth rate does not command the same premium multiple.
Juniper Networks, now part of HPE following an acquisition that closed in early 2025, is a more distant competitor. Juniper's networking products overlap with Arista at the enterprise and carrier level, but Juniper has less exposure to hyperscaler AI networking. HPE is integrating Juniper's capabilities into its broader data center portfolio, but the combined entity has not yet demonstrated the same growth trajectory as Arista.
Extreme Networks and Broadcom are additional reference points. Extreme focuses on enterprise switching with less hyperscaler exposure. Broadcom is a chip maker rather than a networking system company, but supplies silicon to several of Arista's competitors. The most relevant hardware comparison within Arista's exact market remains Cisco, which trades at a significant valuation discount, reflecting its lower growth profile.
On relative valuation, Arista's 20 times trailing price to sales compares to Cisco at roughly 3 to 4 times. That is a 6 to 7 times valuation premium. The gap is justified by growth rate differential. Arista's 35% versus Cisco's mid-single digits but it means Arista requires sustained outperformance to hold its multiple.
The options market heading into ANET earnings showed bullish positioning. Call interest exceeded put interest across near-term expiry dates, consistent with traders anticipating an upside earnings surprise. AI infrastructure names have generated significant options activity as institutional investors take directional positions ahead of earnings cycles that could confirm or challenge the hyperscaler spending thesis.
The implied volatility structure before earnings showed elevated near-term IV relative to longer-dated options, reflecting the binary nature of an earnings print, where either hyperscaler order visibility is confirmed or the CapEx timing concern becomes a risk-off catalyst. With a 7.7% EPS beat, the upside scenario played out and call holders benefited as IV collapsed post-print.
On insider activity, Arista executives have engaged in scheduled sales under Rule 10b-5-1 trading plans, automated, preset transactions that execute without real-time discretion from the insider. These are standard for senior executives with large equity positions and are not a signal of changing conviction. There have been no notable open market purchases in recent filings. CEO Jayshree Ullal has significant long-term equity exposure through her founding-era grants.
The overall read from options and insider data is neutral to constructive. Pre-earnings options flow leaned bullish and was validated. Insider sales are structured planned transactions rather than discretionary selling. The fundamental story, hyperscaler AI networking demand converting to Arista revenue, is the primary driver, and neither options flow nor insider activity contradicts it in any meaningful way.
Arista delivered a clean quarter. Revenue beat, EPS beat, margin held above 60%, balance sheet debt-free with nearly $2 billion in cash. The AI networking secular thesis is playing out in the numbers.
The concentration risk is real. 30% of revenue from 3 customers means one CapEx decision can move the stock. But if AI infrastructure spending continues, Arista is positioned at the center of it.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.